with that perspective. Anshul Saigal is now joining us. He's Head and Executive Vice President of Kotak PMS. Anshul, pleasure having you back on the program. Thank you very much for your time. Are you at all fielding questions or sort of asking questions about what next for the market in the near term? Because there is a lot of hand-wringing and head-scratching which is going on in terms of what is up, and just an unstoppable move is what we've seen.
Yes, Prashant, thanks for having me. Actually, if you go back to January, February of this year, and you see the market positioning around that time and how it progressed till, say, June, you would notice that the FPI as also the HNIs in the market moved markedly bearish between February and June. As also, portfolio managers started holding a lot of cash. That told you that the market's makeup was negative, that there was a lot of bearishness that was already built into the markets, and any small positive trigger would take the markets up quite high. Lo and behold, that's what's happened July onwards. And we've seen between then and today about a 16-17% uptick in the frontline index. And even this move is most underbought. I mean, if you speak with 10 people on the street, 9 will tell you sell the rally, and that makes you think that this may have legs. So I wouldn't be a seller aggressively into this rally at this time.
Okay, won't be a seller into this rally, aggressive seller in this rally. Anshul, hi, good afternoon. So what kind of stocks would you buy right now in this market after the rally?
Afternoon, Anuj. So there, I would look at stocks where earnings visibility is strong. And that, there are many segments in the market where we are seeing that kind of visibility in the markets. Real estate as a space is seeing that visibility both upstream as also downstream within real estate, which means the builders as also building material providers. We are seeing strength in capital goods, autos. We are seeing also strength in sort of import substitution, whether it is sugar, which is substituting oil imports, or defense, which is again substituting a lot of imports into the country. In those pockets, we are seeing strength. So earnings visibility is what we will buy into. And in our judgment, say the next 12 months, you will see companies which seemingly look expensive today become even more expensive.
All right. Hi, Anshul. Good speaking to you as always. Anshul, give us a split up of your portfolio, right? I recall when we spoke last, I think the largest quantum of largest allocation was to small caps, then it was the large caps, and then it was the mid caps. How has that changed around? And also the cash levels, I think, were around 8 to around 9%. The last few months, how has that number moved? Were you in double digits and you'll slowly been allocating? How much do you still have in that?
So we've allocated more to equities. We've reduced the cash in the portfolio. Mm-hmm. And within the portfolio, we've added more to the mid caps. And so you will see the weight of mid caps having moved up. Weight of mid and small caps versus large caps, that has moved up. And so I'd say about 60 to 65% would be mid and small caps. Remaining would be large caps.
So I'm looking at some of what you own. There are names like Balrampur Chini, Blue Star, and I noticed Cyient, which you also own. Again, that is a sort of R&D play, right? Largely.
It is an E-R&D play. That's right. So it's a IT company in the E-R&D space, and particularly it caters to the aerospace and a transportation segment, which is railways. And we see that after a protracted weakness in that space, there may be revival, there may be some tailwinds coming into that space. And as a result, this pocket may be a beneficiary of that trend. which is why we own this name in the portfolio.
Because there are others, right? There is L&T Tech, there is Tata Elxsi on the other end of the spectrum, and then there is Cyient. I mean, is this a turnaround play in that sense, or is it just a play on ER&D?
I wouldn't say that it is a turnaround play so much, because earnings have always been strong in this pocket. In terms of valuations, this space has been re-rated quite meaningfully, and so some of the names that you took, those names have valuations which are quite exorbitant, and which makes us stay away from some of those names. While the name that we own in the portfolio is still reasonably priced, and for that reason, with earnings tailwinds in the works and valuations being reasonable, our judgment is that room for upside remains in this name in comparison to some of the other names that you took.
Have you looked at, I mean, talking about IT, have you ever looked at Zensar Tech, Anshul?
Frankly, Prashant, I wouldn't want to talk about individual names, but sure. I may have looked at it in the past.
Okay.
But I wouldn't want to really, I don't cover it too closely, so sure. I may not be the right person.
I just put that because you own Cyient, and it probably, if you do draw up a list of stocks ranked on P multiples, it would rank right at the. I mean, these two would rank right at the bottom, which is what you want. You don't want to buy 100 P stocks. You want to buy relatively cheaper stocks. I mean, is that one way to go about it? I mean, look for opportunities where, stocks have not really participated in any big, meaningful way when the markets are at all-time highs. I mean, it's hard to find opportunities, isn't it?
That would make investing very simple. And in fact, you wouldn't need a fund manager. All you would need is an Excel sheet, because you could plot stocks versus earnings and just figure out what the price to earnings ratios are and invest accordingly. But as we all know, investing is much more complex than that. You've got to understand way too many dynamics to make a call on a stock. It's not just about valuations. It is about the earnings power of a company. Whether what I mean by earnings power is that if a company has margins of 5% today, is that the stable long-term margin of a company, or can the margins expand to 10%? Now, that cannot be plotted on an Excel sheet. That requires some judgment. And if you can build that, if you can understand that aspect, and then understand, of course, other dynamics like competitive advantages, balance sheet strength, etc., that as a whole will give you a perspective on whether a stock can be bought or not. This is, again, a complex market. We think that some of the expensive names, or purportedly expensive names, will become more expensive because they will have earnings visibility. And that's what one should seek.
We'll shift focus for now.